Welcome video. What if I told you that the money you've worked so hard to save and invest could lose value without you even realizing it? Imagine your savings and investments slowly eroding away because of inflation and market swings. Sounds terrifying, right? But don't worry. Today I'm going to show you exactly how to protect your hard-earned assets from these economic dangers. Before we get started, hit that subscribe button. We're on our way to 1,000 subscribers, and your support will help us reach that milestone. Let's dive in. In the USA, two major threats constantly loom over our financial future: inflation and market volatility. Inflation reduces the purchasing power of your money, making it harder to buy the things you need, while market volatility causes the value of your investments to fluctuate unpredictably. These two factors are a constant challenge, but by adopting smart financial strategies, you can protect your assets and ensure that your wealth continues to grow, regardless of external pressures. Understanding inflation and market volatility. Let's start by understanding what we're up against. Inflation happens when the prices of goods and services rise over time, causing your money to lose value. For example, if inflation is at 3%, something that costs $100 today will cost $103 a year from now, eroding your purchasing power. On the other hand, market volatility refers to the rapid and often unpredictable price fluctuations in the stock market. The markets can go up and down based on news, economic reports, and global events. While this creates opportunities for profits, it also increases the risk of significant losses. Both inflation and volatility are natural parts of any economy, but that doesn't mean you have to sit by and watch your assets shrink. Diversification, the first line of defense. One of the best ways to protect your assets from both inflation and market volatility is diversification. This means spreading your investments across different asset classes, stocks, bonds, real estate, and commodities to minimize risk. By diversifying, you reduce the chances that a downturn in one sector will wipe out your entire portfolio. For example, during a market crash, bonds may hold up better than stocks, or certain commodities like gold might increase in value as investors seek safer assets. Diversifying into international markets can also offer some protection if the U.S. economy is struggling. When you spread your investments, you increase the likelihood that at least part of your portfolio will perform well during tough times. Inflation-protected investments. Now let's talk about how to specifically combat inflation. One powerful tool is to invest in inflation-protected securities. In the USA, these are called TIPS, Treasury Inflation Protected Securities. These are bonds issued by the U.S. government that adjust their principal value with inflation. So as inflation rises, the value of your TIPS investment rises as well, providing a hedge against inflation. Another great option is to invest in real estate. Historically, real estate has outpaced inflation, and owning property or investing in real estate investment trusts, REITs, can offer both income and appreciation potential that aligns with inflation. As property values rise with inflation, so too does your wealth. Commodities and precious metals. Next, let's talk about commodities, which can be a great hedge against both inflation and market volatility. When inflation rises, the prices of commodities like gold, silver, and even oil tend to go up. These assets are considered safe havens during uncertain times because they hold intrinsic value. Gold, for example, has been used as a store of value for thousands of years, and during inflationary periods, its price typically rises as the value of the dollar decreases. So, adding some precious metals to your portfolio can be an effective way to protect against inflation. Stock market strategies for volatility. While the stock market can be volatile, it doesn't mean you should avoid it altogether. Long-term investing in the stock market has historically outpaced inflation. The key to mitigating volatility in the stock market is focusing on quality. This means investing in companies with strong fundamentals, solid earnings, reliable dividends, and a proven track record of weathering economic storms. Dividend-paying stocks are particularly valuable because they offer consistent income, regardless of stock price movements. These companies are often more stable and can be less susceptible to short-term market volatility. Defensive stocks, such as those in the utilities or consumer staples sectors, tend to perform well during economic downturns because they provide essential services people need, even in tough times. Building an emergency fund. One simple but effective way to protect your assets is by creating an emergency fund. While inflation may erode the value of your cash over time, having a reserve of cash in a high-yield savings account or a short-term bond fund ensures that you have liquidity during times of market downturns. This emergency fund will act as a buffer, allowing you to avoid selling off investments at a loss if you need cash during a market dip. Alternative investments. In addition to traditional stocks and bonds, consider alternative investments. These include things like cryptocurrency, peer-to-peer lending, private equity, or art and collectibles. While these investments come with their own risks, they often don't correlate directly with traditional markets, making them a useful tool for diversification. For example, certain types of real estate or art can appreciate over time, independent of the stock market, and offer another layer of protection. Cryptocurrencies, though volatile, can be seen as a store of value, especially in an inflationary environment where the supply of fiat currency is increasing. Rebalancing your portfolio. Once you've diversified your portfolio and invested in various assets, it's important to rebalance regularly. Over time, some assets will grow faster than others, and you may find that you're too exposed to one type of investment. Rebalancing involves adjusting your portfolio back to its target allocation to maintain the level of risk you're comfortable with. Rebalancing helps ensure that your portfolio stays aligned with your long-term financial goals and protects you from overexposure to any one asset class. It's also a great way to take advantage of market downturns by buying assets when they're undervalued. So, there you have it. Protecting your assets from inflation and market volatility doesn't have to be overwhelming. By diversifying your investments, focusing on inflation-protected assets, incorporating commodities and real estate, and developing a solid strategy for the stock market, you can shield your wealth from these economic threats. And don't forget to build an emergency fund, explore alternative investments, and rebalance your portfolio regularly to keep your financial future secure. If you found this information helpful, make sure to subscribe to the channel. We're on the road to 1,000 subscribers, and your support can help us get there. Thanks for tuning in, and stay financially secure no matter what the markets throw your way.